Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Jeff Kilburg, Chief Investment Officer and Portfolio Manager over at Sanctuary Wealth. Jeff, it's great to see you, particularly on a day where the S&P 500 has officially gotten into correction territory. And despite all of the noise around interest rates and the Fed and the geopolitics and supply chain, it's actually options expiration Friday. Do you think that has anything to do with what we're seeing?
I think it certainly does, Jill. And to your point, whenever you see options expiration, there's nearly $2 trillion with a capital T, $2 trillion of options derivatives expiring or being re-rolled. So when you talk about that, I know there's a high concentration. A lot of puts were bought at 4,000 in the S&P 500. But if you think about just the bigger picture, it doesn't feel good. Let's be honest, it does not feel good. But there is a sense of relief I have today that we finally hit this target of 20% off the all-time high. So we are officially in a bear market. A lot of different ways to measure it, but nonetheless, the old measure of 20% down off the all-time highs for the S&P 500 puts us in a bear market. I think that provides a little bit of anxiety, a little bit of relief for some of the folks that have seen the algorithms really drive us towards this target. Couple that or amplify that, Jill, with this options expiration. I think we do have a little bit of a relief bounce coming here. If you look at old support becoming new resistance, I think that takes us back up to about 4150. And it could be in a very vicious manner, in a very volatile manner, in the same way that we've just seen significant selling pressure. I think this is the 7th consecutive week of selling pressure in the S&P 500. And we haven't seen this type of selling pressure in 21 years.
Yeah. Well, Jeff, let's talk about your wheelhouse for a moment here, rates. And I just saw out of the corner of my eye that yields are relatively unchanged despite the volatility that we saw this week.
Well, and you know that I really look forward to bond leadership. I talk a lot about the 10-year note. That's where I cut my teeth in the bond pits. And I have a lot of leadership attributes when we're doing portfolio construction. We want to understand where the 10-year is. Well, the 10-year, it took from 1.53% this year up to 3.2% just a week ago, just last week's trading session. So that velocity really put a lot of nervousness, a lot of selling pressure, specifically on technology. And my focus was that if we could see the 10-year note come back down in yield, drift back down to 2.75, that may put a little bit of tranquility into the equity markets. We haven't seen that yet, but that's what I'm looking for and anticipating next week. Now we've seen these yields potentially stopping, maybe some form of reaction from the Fed, maybe not being as hawkish because they've seen just such a blunt instrument. They've come out with their microphone talking about how they're just going to continue to combat inflation, which they need to, but it's more about the misstep that the Fed took last year. They should have never been buying and expanding their balance sheet the way they did. So now they're trying to once again recorrect, but the pendulum swings too far every time historically for the Fed. But the 10-year note, to your point exactly, I think that is putting us in a pretty good position for a rebound. And typically on the Monday after the S&P 500 expiration, you do see a little bit of a bounce. There's a specific reason why you're seeing this move today be amplified in an already jittery market.
Right. And Jeff, you said at the top that you feel a little bit better that we finally got this swoosh. We got into bear territory here. There are a number of stocks out there that valuations have reset. They're good companies. They're profitable. Their earnings were good. They have good cash on the balance sheets. Do you start to pick at some of these names at this point? Do you think that flush is perhaps in the market? I know we can't pick tops and bottoms, but we can think about attractive entry points for some stocks that look really attractive from a valuation.
Absolutely. We talk about these big blue chip tangible names, the Essential 40 portfolio, which I manage, really focuses on some of these industrial names, some of these energy names that have really done well inside of this distress. But when you talk about owning these names and talk about the way you own them, if you own them in an eco-weighted manner, look at the S&P 500, Jill. The eco-weighted S&P 500 is only down 13%, where the market cap weighted S&P 500 is now in bear territory, over 20% down. So I think you have to be considerate of what you're owning, the sectors you're owning, but this is the time. You have to reposition. You have to tax loss harvest. This is not the time to crawl underneath your desk. This is actually a time to embrace because you will see volatility. And remember, folks, volatility makes markets move down as well as up.
Yep. Great insight as always, Jeff. Appreciate it. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.